walking away from a salary paying $200,000 a year in oil and gas is crazy. Well, so did all my friends and family. But I had bigger goals, and I want to show you what that exactly looked like. So in 2010, I bought my first rental property in Laramie, Wyoming. This one was a great one. My dad, if you guys haven't heard the story, my dad helped co-sign with me, and it's been a great asset I still own to this day. From there, I went and worked in oil and gas here in Houston. I started with Shell in 2012. For like 3 to 4 years, I didn't buy another property. I just kept the same property, but I kept working my W-2 job. But then, like a lot of other people, I read Rich Dad, Poor Dad around 2015, 2016. And I read this book and it changed everything, right? Then I understood the value of an asset versus a liability. So then I just started buying more and more properties. So I brought property 2, property 3, 4, 5. But then I started to hit my kind of first obstacle, which was how do I continue to finance these deals? Because to that point, I was able to use my Fannie Mae, Freddie Mac, like secondary market mortgages that had great rates and great terms. That's when I started working with small banks and really starting to scale up. And the other thing I was doing was I was finding these local banks where I could go in and I could basically force the value. It's called forced appreciation, where I would find a property at a discount off market through my team, and then I would use my contracting team to go in and fix up the property. That was creating a bunch of equity, and I was also fixing and flipping, selling properties, creating a bunch of revenue, and could keep the whole thing going, right? But then I hit another wall, trying to break through that wall. That wall was, again, having just enough capital. That's when we started working with private money lenders to buy more and more deals. But then, again, we keep hitting all these different walls. The next wall was when interest rates started to rise. When interest rates rose, all of a sudden, all these deals I was buying, they were no longer penciling, right? So I had to figure out a solution, and I was already doing this. I was already working on creative finance, right? And this was a complete game changer for me. But when I started to apply the concepts of creative finance, it helped me buy more and more deals to where I could really continue to grow and scale. And ultimately, it was what got me this house. I want to use this house as an example to show you guys creative finance. So the first property we looked at was actually what I call a SubTo transaction. So the seller actually had a $1.6 million loan at like 2.25%. And he was actually willing, it was an assumable loan. So I approached this seller and said, hey, I will assume your loan and I'll pay you the difference for the value of the house. Anyway, this one didn't pan out because there was a bunch of cash offers and they didn't want to go through the hassle of us assuming their loan. But the second one was very similar as well, to where it was a property that had a loan in place. And I'm like, hey, I want to take an existing loan, take the advantage of rates when they were like 2 to 3% a couple years ago and buy a house that way. Anyway, second one didn't quite pan out. But then this one we're sitting in today was just a little bit more unique. And it's a whole nother strategy, because I was looking at taking over a property subject to the current mortgage. Also, sometimes people will just go assume that loan. When you do an assumption, you actually go through the bank, and not all loans are assumable. So again, think of assumption as one process. SubTo is when you don't actually formally assume it. The mortgage actually stays in the seller's name. And we've done so many over the years that we can make our sellers feel comfortable with that staying in their name because of the way we structure the deal. They're actually very well protected, right? So that was assumption and SubTo. The other way is if the house is free and clear, then you have all the options in the world to go structure a deal. So that's how we got this one. So this house comes up. I actually knew the seller. Here's what's really unique is when this house popped up, it wasn't on the market. It was a coming soon. Another agent actually sent it to me and I saw who was selling the house. I'm like, and it was actually a lady that I knew, and I'd actually worked with her and her husband several years ago. They actually had a property right next to my primary residence that they had been selling for a while, and it was sitting on the market. And I thought it was a perfect value add to go in and fix and flip. Well, actually, literally I had these people in my office at the time in our old house. I was running them through a pitch deck, showing them and say, hey, here's how I can go flip this house. Why don't you guys just finance the purchase price? I'll go finance the rehab. We'll flip it and then we'll profit share at the end. Anyway, we didn't end up doing the deal, but I built a relationship with them and built some trust where the seller knew me when she was going to list this house. So I called her up and I'm like, hey, I'm gonna make a guess here and assume you guys own that house free and clear. She's like, yep, you're right. I was like, would you guys be open to seller financing or carrying a certain amount of the mortgage? She's like, you know what, Casey? That's actually what my husband prefers doing. And so why would somebody want to seller finance a house? Let's think about that for a second. They had bought this house for probably, or maybe their cost of the house when they bought it, like this was built in 2013, 2014. So when they bought it then, their cost was probably around $1 million, maybe 1.5 million. What we ended up buying it for was closer to 3 million. So that's almost, when you talk about capital gains, that's like $1.5 million of gains that they're gonna pay taxes on. So if you guys do know the tax law, when you sell your primary residence, you can actually, a lot of that's tax free, but there's a cap on that. I think the cap is either it depends. It's either 250,000 or 500,000. But after that, you start getting taxed like you would on normal gains. Right? So there was a lot of incentive for them to not go, because if they went and sold this house that I'm sitting in today, if they'd have sold this for 2.8, 3 million that they wanted as is cash, they would have paid a boatload of taxes on the difference between what they bought it for and then what they sold it for. So what I positioned it is say, hey, well, why don't you finance it to me? So the way that you do is you break out those payments over time. And then if you break it up correctly, again, this is where you talk to your CPA and somebody and figure out the best structure. But if you break out these payments over time, then they actually don't pay near as many taxes. So it was a win-win for them. And then let's think about it on my side. So, and this could apply to a ton of different people who are trying to buy a property right now. Maybe it's they don't have a W-2 income and they're self-employed. Maybe it's the fact that they just can't make a deal pencil right now when you're borrowing at 7, 8, 9%. I've had so many conversations, actually people in this neighborhood, they're like, how did you finance that? How did you get the seller to seller finance it? I would love to go buy a new property for my family, maybe, or an investment property, and I would love to buy it on terms. I would love to go assume somebody's loan. I would love to structure a contract for deed or a seller finance. So as I'm having conversations with all these other homeowners that are looking to maybe go buy a bigger house, they got really interested in, hey, how do they actually structure this deal? So again, it was really this simple. I talked to the seller, we created alignment, the fact that they didn't want to sell it all for cash. They wanted the seller finance it. So it was really simple at that point. We just decided on a purchase price, a down payment, an interest rate, and the monthly payments, just like you would with another bank. But the beauty of all this is it's all negotiable. It's just, hey, what works for both sides? It's not like you're working with JP, Chase, or Wells Fargo and you're dealing with an underwriter and dealing with Fannie Mae, Freddie Mac. Like literally, we got to set up our own deal. So we're able to structure this house and buy this house through seller finance. I was able to give them a nice chunk up front and now I can pay the rest. I'm actually got this financed over 30 years. So we do deals like this all the time. Often our sellers, they don't want to carry it for 30 years. These people actually do because of the tax implications, right? And they don't need all that cash up front. But a lot of times when we structure a deal like this, especially when it comes into multifamily, I'm actually doing this right now up in Wyoming on a 45 unit, same situation. Seller had it free and clear, didn't have any loan on it. So she was willing to carry the majority of the purchase price and I just gave her a down payment. But a lot of times these sellers don't want to wait 30 years. So often we'll put a 5-year balloon at the end of it to where within 5 years, interest rates should settle out or a lot of things change, right? If you look at it on average, I think on average, no loans don't typically go longer than 7 years. So typically you're either gonna wanna refinance or you're gonna sell it or do something different within 5 years. So I don't usually mind putting a 5-year balloon on a seller finance deal, which is exactly what we did on our multifamily property is we structured, that one actually has a 2-year balloon because on that one, it's a value add where I'm going in, I'm fixing up the property, I'm stabilizing it, getting tenants in there to where we get the value up, and then I can go to the bank and I can refinance it. So this concept of creative finance might be new to you, but it is not at all new to the world of real estate. People have been doing this for decades. I've been pitching creative finance for years and always been like, hey, whenever I had a seller, they're like, hey, would you be willing to let me take over your loan? Or if they had it free and clear, can I make payments to you? I've been pitching this for years, right? But I didn't really get traction until I really started doing a ton of marketing and talking to a ton of sellers. I tell people this all the time. In my business, our goal is to talk to between 15 to 30 motivated sellers per week, like new motivated sellers I talk to that my acquisitions team is able to generate and put in front of me. So I am pitching creative finance 15 to 30 times with new people per week. It becomes a numbers game at that point to where if you pitch this enough times, I get really good at actually being able to articulate it. Also, it's a numbers game. There's a lot of people you're gonna go say, well, A, there's not a lot of people who own the property free and clear or that have a assumable mortgage or are willing to assume their mortgage. So that's one hurdle. But then let's say that you got somebody who has it free and clear, but a lot of people just don't understand, well, why would I ever seller finance it to you? Why would I just go sell it? But that's when you got to understand how to present, hey, there's a big tax savings here. Hey, you're actually going to make more money on the property. And as I've gotten really good over the years of presenting this, we've gotten better and better and better to where now actually I've had a lot of people specifically in our neighborhood. They're like, hey, I want to buy a house like you did. How do I do that? And a lot of them are like, well, first off, I say it's a lot of work. You're gonna have to spend a lot of money on marketing. You're gonna have to talk to a ton of sellers. And a lot of people don't wanna do that. So what we're doing more of now is we're actually doing some marketing. We're looking for leads around this area to where I can go set up the same structure of this transaction that allowed me to buy this house. I can go set up that and basically turnkey it to where another homeowner can go find a property just like that. The other piece of this is buying investment properties. Because a lot of people I talk to, they want to get into real estate. They want to buy a rental, but maybe they don't have the full down payment. Because right now, especially with the way prices have gone up on houses, maybe your entry point into a house now is $400,000. Well, at 20%, that's a big chunk of money. That's $80,000. And somebody might not have that much. But creative finance can allow you to get in with low to no money down. But the other piece of it is they can't get deals to cash flow right now in pencil based on borrowing at 8 or 9. I mean, if you're borrowing on a non-owner occupied, you might be paying 10% right now through a bank. So it's hard to make those numbers work. Well, unless you're doing creative finance. So we do so much of that now to where we go and find the deals. We go and do the again, where I'm working my pipeline to find the deals, talk to sellers, get a seller finance or a SubTo, any form of creative finance under contract. I take it over. We go fix it up if we need to. We go place a tenant if that's needed, and then we hold the asset. And then a lot of times what I'll do is I'll actually sell this to another investor or just another guy that's got a great W-2 income that wants to get into real estate passively. We'll sell that property. And again, they don't have to go find a loan now because it's already teed up. We're either assuming a loan, taking a loan over subject to, or the seller is just simply seller financing it. So we tee that all up to where all they got to do is come in for what we call an entry fee. It's all based on how much money that we had to give the seller, how much money we had to put in the rehab, and obviously making sure we pay our company a profit for finding the deal. We work all that into what's called an entry fee to where now that investor can come into the property completely turnkey. And we're finding deals that are still penciling well to where they're getting in for 20, 30, 50, maybe $100,000, and they can get in the deal and it's going to cash flow on day one. So it's a really cool way to continue to use and leverage creative finance to continue to go private properties. The last thing that we're doing though is we go find the deal and we package it up under our fund, right? I just did a deal with 45 units up in Evanston, Wyoming, where we actually packaged it as 2 different forms of debt. Again, my seller financed me the first portion of the debt at great terms. It was like 5% interest only for 2 years. And then I went behind that and I brought in investors in second position. We actually paid 15% interest on this deal, which I think is really good for an investment backed by real estate. So we stack that up to where our investors get a return. I'm able to go buy a property through creative finance. And then the strategy is when we're all done and stabilized, I refinance and then I pay back the seller and then I pay back my investors. And then we can go do another deal just like that. The other thing we're doing is bringing in parts of our portfolio to where I go find 5 different subject to deals or 5 different seller finance deals. I package them all up and I put them into our fund, and then I can bring in limited partners, which are just average investors. It is for accredited investors, so you do need to be accredited, but I can bring in multiple limited partners to buy into this fund. So now they have ownership of this collection of properties that have these great terms because we negotiated them using seller finance. So as I wrap this up, my hope is it kind of explaining my story of, again, why I wanted to leave a great paying job to go out and do this on my own, and why I had like ambitious goals and wanted to provide a beautiful house like this to my family. None of it ever happens if I don't understand creative finance, if I'm not willing to go out and hustle, and I'm not willing to like leave my comfort zone. But you guys, I'm not expecting everyone to be like me and want to go quit their job and want to go build a wholesale company and do fix and flips and manage properties and do all that and learn creative finance and invest all that money to do it. You don't have to do all that. The easy way is to partner with us or to lend on one of our deals. I love the people that come to me and they're like, Casey, I'd love to invest on one of your deals so I can learn the process. Or, hey, Casey, I'm stuck. I got this seller who's really motivated and I think they'll do seller finance, but I'm not quite sure how to structure it. I work with people all the time to help them do this. And if I can help you close a deal, that's awesome. I've been doing it. I get all the reps, and if I can help somebody else do it, even better. So if this is you, whether it's you want to be a partner, whether you want to be a lender, or you have your own deal that you need help with, or maybe you're the guy here in Houston that wants to buy the next house for your family and wants to structure it creatively, I want you guys, there's a link below to book a call. I want to hop on this call and understand your situation and see if I can help. If you liked this video or thought it was helpful, please like and subscribe, and even better, share this with somebody else who you think it might help.